Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so home prices for the first time ever passed 400,000.
So, are we talking about median home prices, or what are we
Median home
talking?
prices.
Okay, got it.
First time.
First time.
This is something they've always tracked. This is a nationwide number. They're over 400,000.
Right.
Okay. U.S. existing home sales tumbled to a two-year low in May as prices jumped to record high, topping the $400,000 mark for the first time, and mortgage rates increased further, pushing out entry-level buyers to the market. So let's talk about this, Juana. This is what's going on. Prices going up.
Right.
Interest rates going up, and it's cutting out some of the buyers.
It is.
Not all of them.
Right. So we know, look, so the way this works is we know that for every $1,000 that a home price goes up, we lose so many buyers, which $1,000 doesn't sound like much, but, you know, a lot of people are pretty close to that, to whatever that magic number is, as far as qualifying for a loan. So every $1,000 that the home prices go up, we do lose some buyers. And we lose them in two ways. We lose them maybe that they get discouraged altogether and they say, forget it. Or we lose them from that price range, right?
Right.
So if you were going to buy a house that was $400,000, now maybe you're buying a house that's $390,000, $350,000, or some other number. Right.
Exactly. Despite the fourth straight monthly drop in sales and declining affordability. So despite both of those, on Tuesday, the housing market remains fairly hot, with properties typically staying on the market for a record low of 16 days.
Right.
That's this nationwide. With supply so undesirably low, prices could remain elevated, though sellers were reducing list price in some area where bidding wars were prevalent. So people are talking about, I keep hearing this, prices are falling. But they're not really falling. What's happening is the list price. People usually when they list a really high price.
Right.
A lot of people do that. And then they do price reductions until they get it sold.
Right.
So this is that normal thing. It actually happens every year.
So here's kind of anecdotally, we had somebody who contacted us and said, hey, my house is listed for this much and it's been on the market for 2 weeks and it hasn't sold. And I wanted to laugh, which would have been very insensitive. And so I did not do that, but I was laughing on the inside. And so it's like, okay, so your house hasn't sold in 2 weeks and you're panicking? I mean, look, houses aren't supposed to sell in 2 weeks,
right,
okay? Yeah. Houses are supposed to sell after sufficient buyers have taken a look at the house, have found it to their satisfaction, both as far as the house, the location, the price, all these other things, and then they make an offer. So just because your house didn't get 20 offers, it only got 2 or 3 offers, that doesn't mean that the housing market has tanked, right?
Right, yeah. We've actually got a whole nother video that we're going to do where we go over all the national numbers, and you're going to be shocked when you see that this happens every year.
Right.
This thing that is apparently getting the impetus to crash the housing market. It's you basically every year the same thing happens, but that's actually another video. You have to subscribe though if you want to watch that video.
And hit the notification bell.
Yeah. Existing home sales should continue to slow over the course of the year as mortgage rates move higher, says the chief economist at Nationwide. But in the absence of a deep and sustained economic downturn, home sales should not drop as they did in the housing bust, allowing prices to continue to move higher on air. So let's read this again. Home sales should not drop as they did in the housing bust. So people will still be buying homes.
Right.
Allowing prices to continue to move higher on average.
Right.
So even with a minor recession, this chief economist in a mortgage company is saying home prices are going to keep going up. Right.
So here's the thing, barring some black swan event, which, Lord knows we've had enough of them in the last few years, the housing market will kind of settle itself in. It'll still kind of keep climbing, hopefully climbing at a regular rate, which is about 5% a year. And then when we throw inflation in there, so we might see housing still go up maybe 10% a year until inflation gets under control, but somewhere in there.
The housing market is the sector most sensitive to interest rates. Its slowdown could help bring housing supply and demand back into alignment and slow price growth. So what this says is, instead of prices growing at 15% a year, they may grow at 5 or 3.
Right. And remember,
which is the idea. The idea is not to, they're not trying to destroy the housing market with interest rate. They're trying to cool inflation. And clearly, when home prices are going up 15% per year, that's an inflation-related thing. That's something they're trying to fix. Because if if they crush the housing market, they're going to crush everything even worse.
Right. So remember that when they're crushing the housing market, they're crushing a whole lot of ancillary industries that go along with it. So we're talking, construction. We're talking durable goods like washers, dryers, cabinets, flooring, all these other things that go along with it. So it is so much more than just purchasing a house.
Yep. The median existing house price raced 14.8 from a year ago. Earlier, an all-time high of $407,600 in May, crossing the $400,000 level for the first time. What's interesting about this is, remember, interest rates have been going up for over 6 months now. And the conventional wisdom was, well, as soon as they go up, it'll start tanking because there's less people. So here we've had 6 months of interest rates going up, and we still have prices going up.
Right. Right. So we have prices going up for a couple of reasons. One, because people need a place to live. Two, we still have low inventory levels. And three, we still have buyers who are looking at this and saying, hey, you know what, 5-6% interest is still better than 8% interest, and I'm going to take this while I can, but while houses are still going up in value and interest rates are still going up. So if I'm going to do it, I may as well do it now as opposed to 6 months from now when I'll pay more for the house and maybe more in interest rates too.
First-time buyers accounted for just 27% of sales, which economists said also explained why double-digit home price growth persists, even as discounts become more common. All cash sales made up 25% of transactions. Those are mostly Wall Street institutions taking advantage of the rising demand for renting. This is new. This is something that's happened within the last decade.
Right.
The Wall Street coming in, buying all the houses. They're this artificial thing, which is one of the reasons why home prices are going up. Even with mortgage rates going up, the reason it's not having this massive effect is, first of all, 5% is historically, borrowing money at 5% to buy a house is nothing, because the cap rate on a rental is usually more than that.
Right.
You're still making money if you in theory, you could still go buy rental houses and still make money on them.
Right.
Okay? Not counting the appreciation of the house, just the cash flow of it, right? But the fact that Wall Street's in there basically with cash, which is cash doesn't care about interest rates. Actually, all they care about is that they're trying to deploy this cash so it doesn't get killed by inflation. Right.
So that's exactly what I was going to say is, this cash is really important because this cash is being devalued every day due to inflation. So they do need to deploy it in order to protect it. And then the money that has been borrowed by these large institutions has been borrowed at a discount, which again, they need to deploy the cash in and put it in something that has intrinsic value like real estate, so that the cash won't depreciate and it won't be wasted.
Okay, so you got the federal funds rate, which I think is like 1.5%. You have a normal human being who can go get a mortgage is probably between 5 and 6% now. But Wall Street firms are still borrowing money way cheaper than that.
Right.
So even at the probably 2 or 3%, they're probably borrowing money at 3%.
Right.
The money that they're borrowing at 3% is still worth it for them to flood the real estate market.
Absolutely.
I mean, even let's say prices do start going down. Why wouldn't they keep buying houses as prices go down? Because they're getting even better because rents aren't going down.
Right.
Rents are going up, and you really don't care what the value of the asset is. All you care is that you take some cash, and then you could call it a banana, but you get the banana gives you a return every month in the form of rent.
Right. So the thing to keep in mind is that these hedge funds, these institutional buyers, they really have not had anywhere else to hide besides real estate. With the stock market going down, bond market not doing well, they have to deploy this money somewhere because this money is being depreciated because of inflation, and they have nowhere else to hide besides real estate.
Yeah. It'll be interesting, though, to see what happens, because it's very unlikely they can just sell the houses in the future. They can't just go out and say, okay, let's just start putting them on the market and selling them.
Right. Well, they wouldn't do that. What they would do is they would package them.
It would cost too much.
Right. It would cost too much, and they would be actually depreciating their own assets, because if you go in a market and you put 1,000 houses up for sale all at once, then there's going to be downward pressure in that particular market because you've got so many houses flooding at the same time, so they wouldn't do that. Plus the transactional cost to sell the houses, again, that bites into their bottom line. They're not going to do that either. In the most in most scenarios, what we envision is that they will bundle these houses and they will sell them to other institutional buyers. And they're going to be in large pools, 50 million, 100 million, 300 million, whatever. But they're not going to be readily available for you and I, individuals, to purchase as investors.
Yep. And they won't count as a sale.
No.
It won't be like, oh, last year 1 million homes sold because Bank A sold their interest to Bank B.
Right.
They'll just say, give me some money, these are yours now.
Right.
But that doesn't count as, they don't average the houses and say, well, how much did you pay and what's it worth on average? Banks, they use this thing called mark to market. So
right.
where the value is based on what they purchased it at, and then the next guy that buys it just pays some amount.
Right.
And it's also based on how much rents get returned, like
right.
how much money is coming in cash.
Yeah, so it's a much more complex formula. So it's based on what they paid for the asset. It's based on what the life of that asset is. It's based on the amount of rent. It's based on a whole lot of different things. So it's not like a regular single property being sold.
Obviously, inflation going up, inflation being high, that's a positive for real estate values.
Right.
Because a recession is actually a positive. We just did a video on that because real estate does very well during a recession because people tend to move into real estate and move out because stocks get crushed in most recessions. Stock
right.
prices tank 20, 30%. Like if you look at the big recessions, which was the dot-com bust and then the recession that was caused by the housing crash 2008, 9, 10, where the stock market really just got hammered there. Right now you have brand name stocks that are down 80%, right? Like large cap stocks that are down 80%. They're 20% of the value, and real estate's been outperforming that. So, with Wall Street buying, with all this, the idea is, we've been saying this for a while. If you look at the long-term graph of real estate, it goes up at 4.7% per year. The last 2 years, it's been going up at like 10 to 15% per year. And that's too much. It needs to just go up at the normal rate. But even if it went down, Wall Street wouldn't care. They would keep buying, and people wouldn't be forced to sell. They would just. Why would you get rid of your 2.75% interest rate? Because your home is that you paid $200,000 for. This now worth $350,000, maybe went down in value to $300,000. You still wouldn't sell it and go, oh my God, it's falling. I better sell it. This is not E-Trade where you click a button and the house sells.
Right.
And then you have to live somewhere.
Right.
You're not just putting the cash in the bank and saying, oh, I've got my cash, right? And then what would you do? You go out and buy another house and pay 5-6% interest? You wouldn't do that, right? And that's really a topic for a whole nother video, which is the inventory that will now be locked up because people will say, I'm never selling this house. I'll move and go buy a new house, but I'm not selling this house ever because I've got this 2% interest rate or whatever. I can't get rid of that.
Right.
And that's another thing artificially that's going to, I think long-term for the housing market, I don't know what stock and crypto and all that's going to do, stock market in general. And obviously as the economy grows and stuff, the stock market will follow it. But real estate just to me looks like it's kind of cruising along. And I don't know any long-term investors that have talked about selling anytime soon. Like they're all saying, and most of these people own the homes free and clear. They're never ever selling.
Right.
Like they will die and then just will the kid, it's in the property's in a trust, the kids will get them.
Right.
Like they're just, why would they want to sell it?
Right.
There's no reason.
Look, so long as the homes are free and clear or nearly free and clear, or they've got these fantastic mortgages, those homes provide a lot of support for the whole real estate market. And we know we've talked about this before, that basically half the houses out there are free and clear. And most everybody has at least 10% equity in their homes. So there's a lot of support for property values.
It's 98.5% of all people have over 10% equity. So only 1.5% have less than 10% equity. What that means is if you have a $400,000 house, you owe $360,000 or less on it. 98.5% of the time. I think people are missing out on this. Actually, of course, home prices are up. There's more wealth, there's more equity in homes than there ever has been ever.
Right, which is part of the reason why the Fed is raising interest rates, because they are, and that's part of the reason why there's inflation is so high, because there is so much equity, there is so much wealth, and it's kind of locked up, and it is it is causing all these shifts in the economy, and the Fed is trying to deal with it with old tools. I think they're going to have to come up with some new tools to deal with this, because this is unprecedented, and they're using old tools to deal with a new situation.
If you liked the video, please subscribe, hit the notification bell, share it with your friends, and leave us a comment.
Absolutely.
And we will see you on the next video.
Bye.
Bye.